Good morning, everybody. First of all, I want to thank Omar. I want to thank Tamika for being here today. We've had a 20-plus year partnership with this group, and you see some groups here that have been attending Coffee and Cappers and became advocates for the organization. You can contribute, you can talk to Tamika about how to become more involved. There's internships, there's a lot of things that you can do with the organization, which is fantastic, and please take your time to do that. I want to thank Gail Donovan. I want to thank Ivan Petrovich, my partner, Walia Ahmed, and also Adam Pollack, all of which put together this amazing presentation. Without them, I wouldn't be able to stand here and speak to you, so thank you for that. I want to also thank Ralph, our friend from TD Bank, and thank you so much for hosting us in this incredible building and great location. Thank you for that, and thank you for the panelists who agreed to be with us today and tell us about what they think about the market. Our company, Ariel Property Advisors, a real estate investment services company, has three groups. The first one is investment sales. We sell buildings throughout the city of New York. We add value to our clients by providing the best information and also providing them understanding of the capital markets. That's with our professionals on the debt and equity side. We have a big research group. Much of the presentation here is from the research reports that you can download, and they're in front of you. All of our 60 people are involved. We're one team, are involved in everything we do, including all 7 partners, Victor Sozio, Mike Tortorici, Ivan Petrovich, Sean Kelly, Paul McCormick, Aviva Viad, and myself. So thank you for your leadership and thank you for being here. We created a partnership last year in addition to that with GREA. This is Global Real Estate Advisors. So now our clients can benefit from a national outreach in 12 different locations. What I want to do today is I want to go through 2024 and talk about transactions and trends in the different sectors that we've seen. We're going to see who said yes to the city and who decided to pretty much run away. We're going to see where alignment is helping transactions and where it does not. We're going to end up with a watch list and we're going to wrap it up at the very end of this presentation. My hope is that you see the positive attributes of New York City investment today the way we see it after this presentation. Okay. And I want to start with this quote. Oh, no, I don't want to start with a quote. I want to start with the challenges. There are $6 trillion of challenges. Actually, they are the commercial mortgages that are on our national balance sheets, and what they do is they slow down transactions. In fact, last year we saw only $350 billion worth of transactions nationwide. That's the lowest amount in the past 10 years. New York City, however, did better. $28 billion, that's growth. That's not what we need to see the city of New York, but it is a one step in the right direction. Now we're going to talk about that quote because it talks about New York City. It's not about the strongest or the most intelligent. It's about the responsiveness to change. And I think that describes New York City and its resiliency over the past year. I want to tell you a personal story. I stepped foot in this city for the first time 40 years ago. My family came here to visit, and I remember walking down Fifth Avenue and seeing this incredible building called the Empire State. That walk left a lasting impression on me. And that's also where I want to start. I want to start with the office market. It traded to the tune of $7.7 billion. That is another step in the right direction. But $2.4 billion of it are not going to stay office. They're going to be conversions. We're going to talk about that. Let's start with discussing what trades are going to stay office, and let's start with a Class A plus. Actually, in fact, let's start with this building, which is One Vanderbilt. SL Green sold 11% of it to an international investor for a pricing of $4.7 billion, or $2,800 a foot. When I say $2,800 a foot, it sounds like a luxury apartment, sale, but it was a Class A plus office building. Another building, Rockefeller Center, received a $3.5 billion refinancing last year, and you have to ask yourself what's going on. Well, There are several Class A buildings in the city. Some of them are going to be here, and you will see the tendency. The tendency are high-end corporations, the hedge funds, financial institutions, law firms, TD Bank. And what they want is culture, corporate culture that's high-end, employee retention. They're looking for the amenitized buildings, and they're looking for a club-like environment. And that's what we're seeing, which is pretty interesting. You know what else we're seeing on Class A Plus? 8 million square feet that are being built right now. You see these companies, some of them are building it for themselves, some developers are building it for others. So the Class A Plus is doing exceptionally well in New York City. Companies are buying buildings, that's the second segment. And we have Bloomberg putting about $560 million in Madison Avenue, joining many other companies that did exactly that in the past few years. And the last segment of existing multi that traded is everything you heard about, the distress. There were about 14 buildings that sold because of vacancies and financial challenges, and you can see the discounts all the way to 60 and 70% in some cases. So this is an opportunity. I want to go back to the $2.4 billion that traded for conversions. And that number is about 7 million square feet. That number contributed a lot to the development market, which grew to $5.5 billion. In fact, there were 19 buildings that traded for either conversions or for knockdowns. And these are the names of the companies who are going to convert them. Now, it's Excel, and it's TPG, and it's Related, it's many others. These are names you're familiar with. These are names that believe in New York City and double down here, which is pretty interesting and gives me a lot of conviction when I look at the city. 3 buildings that were interesting to us are 625 and 655 Madison Avenue, 2 different developers, retail, hospitality, condos on top, 8 West 14, Legion is building it. They're going to knock down the existing building and build high-end condos. So what's really happening there? What are the drivers? Well, one of the drivers is the housing policy and the city of yes. Lifting the density cap was a big deal, providing tax incentives, property tax incentives for conversions was another important element, and the city of yes allowed for every office building to convert if it was built before 91 was another major item. The housing policy didn't stop there. It extended the 421A, the old tax abatement. If the land had a footing in the ground, we've seen 25 transactions taking place exactly because of that. One example is the Pathmark site on 125th Street that traded because of that provision. The housing policy continued with replacing the old 421A with 485X, and the city of yes complemented it with more density and less parking requirements, and we've seen 177 transactions that we believe could take that provision and develop ground-up rentals, which is super important to the city. So a lot is happening in development. When we get to the panelists, we're going to hear them. We're going to hear Joy Construction and Gilbane and CPC talking a little bit about affordable housing and how the housing policy helps it. And the last thing when it comes to development is the condo market. We've seen 72 land transactions that are going to be condominium. Again, see the depth of developers that are doing it, another conviction in the city. So a lot is happening in development. A lot will probably continue to happen moving forward. The multifamily asset class is grown in terms of volume, not a lot, but again, another step in the right direction. It's probably the preferred investment in New York City. It's divided to 3 categories. Free market, where it's barely regulated, rent stabilized, highly regulated, and affordable housing, which is regulated, but has an alignment of incentives. When it comes to free market, it's where every type of investor wants to be. Investors are looking for quality locations, strong locations. They're attracted to the fundamentals, to the high rents in a low supply environment. In fact, rents have gone up by 40% in the past 5 years or so. And they're also attracted to the lower basis. Prices have gone down on average by 28%, even for free market buildings. We've seen institutions buying, KKR buying the Paxton building. They weren't the only one. There were 9 transactions above $100 million that took place last year. We've seen Palo buying 2 buildings, Silverstone buying, Stonehenge, Stockbridge, Fechner, you name it. International investors are in the free market world. It's Japan, it's Korea, it's Germany, it's Israel, it's Europe. And private investors are doing the same thing, looking for the free market, looking for the great locations, and being attracted to the rents and the valuations. And this is the depth of the market for free market multifamily. Now, rent stabilized housing doesn't have that kind of depth. It does have investors, but not that kind of depth. And the reason is HSTPA, the Housing Stability and Tenant Protection Act of 2019, pretty much showed the buildings, the landlords, the city, many of the tenants. That legislation does not allow for rents to grow even upon vacancy. What it does is provides a disincentive to invest in a unit or invest in a building moving forward. In many cases, these vacant units stay vacant with no new tenants. So who's investing in them? Private people, private family offices. And the first reason they're attracted to that asset class is because of the basis. Prices have dropped considerably. I'm going to show you a slide right now. About 8 buildings. The discounts in rent stabilized buildings are all the way to 60% plus. And this is kind of a slide that I show every 6 months. And every time it's different buildings, the discounts don't change. So the first reason someone invests or private money invests in rent stabilized buildings today is because of the low basis. The second reason, the belief that HSTPA, the legislation, is not sustainable because buildings are falling apart. And the third reason, in some cases, you can convert these rent stabilized assets into affordable housing, which gives it a little bit more color and return, which is important. I want to travel with you to Argentina for a second. You know what happened there? In Buenos Aires, they lifted all regulation, and that resulted in a 40% drop in rent across the board. I think that's a big deal. That's something we should learn about here in the city of New York, because we have 2 million rental units, 1 million of which half is in rent stabilized housing. Can you imagine what would happen if we lifted all regulation in one day? Rents will inevitably drop. We saw that, by the way, during the pandemic when demand left the city. We saw drop in pricing. So for those of us who are concerned about affordable housing, and we all should be, remember that rent stabilized does not apply to or does not prioritize affordable housing families necessarily. There's no income restriction or income requirement for tenants to live there. So affordable housing families are suffering from the general higher rents like everybody else. So that is a supply constraint. When it comes to existing affordable housing multifamily, what we see is transactions because of preservation deals that mostly need new capital to provide for the higher quality of affordable housing. In affordable housing in general, we see a lot more alignment. We see government and mission-driven capital working together, where the government provides a lot of incentives to provide that quality affordable housing. It's nonprofits, it is community development funds like TEL from CPC, who's going to talk more about it. It's larger funds like Nuveen and Blackstone. It's private developers like Joey and Gilbane and Treadway that are working together with the government to make it happen, to provide quality, sustainable, affordable housing, and ask for a risk-adjusted return. The part of the return is important. That's where the government comes in. We've seen preservation deals last year on the Knickerbocker Village deal that L&N bought, 1,600 units. That's going to be a preservation deal. We've seen it on Beacon Hughes and 144th Street that our company, Ariel Property Advisors, sold for about $15 million. It had a tax abatement and a regulatory agreement change, another preservation deal. 80 Green Street, Project Bay Section 8, that is going to be a preservation deal. I'm going to tell you that we have right now, Ariel Property Advisors has right now about 2,500 units that are going to sell, most of which are going to be preserved for affordable housing. So it's a big business in New York City, and it's important that the government supports it so we have more affordable units. Retail has done well last year, mostly because of transactions like Prada and Gucci that took place, but investments of Blackstone and Acadia and some international investors took place in Soho. So definite recovery in retail in prime locations. Hotels have done not so well in terms of volume, but very well in terms of fundamentals. You see the average daily rates and the vacancies. Great fundamentals, mostly because of supply constraint. There are not enough rooms in the city. Industrial did well, mostly in bigger transactions. Carlisle and Toronto bought mostly outside of Manhattan. So that leads me to the watch list. And the first thing I want to mention are the local laws, specifically the Local Law 97, which we are going to see put burden on landlords. Mortgage maturities are going to create more transactions in the coming year, which is good for volume. Not great for pricing, but really good for volume. The housing policy is a big positive for New York City. Not perfect, but big positive for New York City. And we have the liquidity. We have a lot of private money here replacing balance sheet lenders, which is pretty interesting. We hope that banking regulations could be lifted a bit and create more liquidity. And the last thing is interest rates. If you ask me what's going to happen, I'm going to tell you I don't know. I hope anybody else, if anybody else knows, let me know. We're going to wrap it up. We've seen that mortgage maturities are going to lead to more transactions. The office market can transact. We see the different sectors in it. And that also leads to more development. Development market is doing well because of that, or better because of the housing policy. Multifamily is a priority for investors. Retail, in many cases, has recovered. Industrial and hotels, the fundamentals are great. So we believe that in 2025, we're going to see more transaction volume and some pricing recovery. In fact, we started seeing that last year with very specific segments and very little recovery, but we believe this year is going to be a bigger one. One of our clients told us that this year is moving from defense to offense. And I think that sums it all. And I hope that you've listened to this presentation and believe the way we do that New York City presents a great buying opportunity today. Thank you.
Good evening. Thank you very much. Okay, so just on here.
Yes, please.
It's kind of throwing me out. Good
morning, everyone. I'm Ralph Bumbaca. It's a pleasure to host today, along with Shimon and the whole team at Ariel. It's been just terrific. You know, I've been a fan of coffee and cap rates for many, many years. I've been attending these events, and then the opportunity to really connect and support as a sponsor, as a host, has just been terrific. We had the last session here 6 months ago, which was a terrific hit. It's great to see the room filled here. We got to really create value in this amazing space. So if you know TD, you know, we believe in New York, we build in New York, and it's just been an extraordinary growth story for us here, and we're excited about today's event. And of course, really what kind of grounds us in today's event is legal outreach and the great work that they do. And Tamika, you have taken over such an important role in the organization, and what you've done has just been tremendous, and we're so glad to continue to support. So last year, there are seats, so if anybody wants to fill in on the seats, please fill in. We're going to call up the panel in a second. But last year, or at the last session that we had, Thomas Brown and I connected from Trinity. I toured 425 Grand Concourse just last week, an extraordinary affordable housing project. They should be commended about what they were able to do over a course of some challenging times, but really an extraordinary project. So if I could tell Eli and Brendan to join us here on the stage. We're going to get into affordable housing, policy, regulations, and a few other topics. And we haven't really formally met.
So I just like it's been tough schedule. It's really tough together with everyone. Thanks to what's called.
Gail, is it okay if I do it from here?
It's whatever makes you more comfortable.
All right. Gail runs the show here, so I got to make sure I stay on point.
No
problem. Close that deal. That's what we want.
Forgot his name. So
There you go. All right. So you know what? Let's start off. If I could ask each of you just kind of go down to each other, tell us a little bit about your organization, about yourself. That would be great if we could start off.
Sure. First, thanks everybody for coming to hear us speak. The nice thing about this panel is the three of us know each other for a long time. Actually met 20 years ago working on an affordable housing deal, just about now. So back then we had no idea what we were doing. I think in the last 20 years we've learned a couple of things. So thanks for coming to listen to us. It's actually very therapeutic for me. I have a 16-year-old daughter who tells me I'm a moron every day, so this is very encouraging for me. So thank you. I'm Eli Weiss. I'm a principal at Joy Construction. I've been there about 18 years. Joy was founded in 1995 as a third-party general construction business. I was working at the New York City Housing Development Corporation. I met the two folks who run Joy Construction, and we figured out that there was a synergy because I knew nothing about construction and I knew there wasn't much joy in it, but I knew I knew a lot about development and finance and affordable housing, and we created a partnership that's gone 18 years. We build about 75% of our practice is affordable housing, anything from ground up tax credit deals, middle income deals, but we also have 25% sort of anything that comes that's interesting we do. So I built medical office buildings for Sloan Kettering, hospital for special surgery, the Civilian Hotel in Midtown, if anyone has ever been, it's a great rooftop bar. And everything from multifamily luxury market to condos in Tribeca. I keep 25% of my business, sort of to keep things interesting so that I don't take that much abuse from all the city agencies. So with that, I pass it on to Tal.
thank you.
Is this working?
I think so.
So obviously it's hard to go after Eli and Shimon, but I'm Tal Metzger. I'm at CPC. CPC is a 50-year-old not-for-profit that provides construction lending, permanent lending, and I run the equity investing platform. Honestly, it's a very bespoke effort to capitalizing affordable housing. Often we're working with developers with no balance sheet, no experience, there's no comps. We're in an area that people don't want to, banks don't want to originate or service loans. So we take a very hands-on approach to all the work that we do. But we've put out about $15 billion over our history and recently took on a portfolio of rent-stabilized properties from Signature Bank. So that's been a large effort, and we're standing up a new affiliate entity that is putting out $2.5 billion of decarbonization money at low interest rates. So everyone should be talking to me after this about that. But the equity investing platform that I run is we own about 5,000 units. We put about $100 million out. We're writing checks of $2.5 to $7.5 million of very mission-driven, but also economically oriented capital. So we're trying to get a market return while also getting the mission. I will say that I represent the one slide that Shimon had of a building with a belt around its waist. So I have some thoughts that are a little doom and gloom, and we've been looking outside of New York State and New York City and finding some interesting opportunities. But our history and our DNA is really here, so we're eager to do more and to continue working in New York State.
Thank you. Great to be here. Good morning, everybody. Great to be here in reunion mode with you all. My name is Brendan McBride. I'm a Senior Development Director with Gilbane Development. I've been in the affordable and mixed income housing space for longer than I should probably specify in public, but I think it's close to a quarter century. Started out with supportive housing development in New York City, converting actually an old hotel into the over 400 units to supportive housing. Cut my teeth there, and then did work in New York City and then in New Jersey doing affordable development of every stripe. And eventually found my way to New York City's Department of Housing Preservation and Development, HPD, where I oversaw the new construction funding programs for affordable housing. One of my main job tasks there was to tell Eli that he was not going to close his deal that season, and then to say it again the next season. Good times. Yeah. Gilbane is a large unified company, both a development company and a construction company. You probably see in the Gilbane signs here and there. It's a large global construction company with presence in 48 locations in the United States. One of the stronger and larger offices being in New York City. and the companies interact on a regular basis, but the development company is a separate company that broke off a mere 50 years or so ago compared to the 150 plus years that Gilbane Building Company has been around. And the development company focuses on 4 verticals: market rate housing, largely focusing on the Sun Belt states, loosely headquartered out of Texas; student housing, which is nationwide on university campuses or near university campuses throughout the nation; and the B3 division, which does some student housing on a leasehold basis on university campuses, and also all kinds of roles that they play in terms of the private actor, executing on transactions, development deals, and construction deals on behalf of a public entity. That can include building new seats for a school system, or renovating a transit hub, or many other things. And then last but not least, I sit in the affordable and mixed income housing vertical. We're the fastest growing vertical at Gilbane Development Company. We're based here in New York City at 88 Vine Street. About 2/3 of the work that we've done historically is in the New York City area, about 1/3 in the DC area. I'm based in Philadelphia, and I'll talk a little bit more about where our geographies are expanding to, including Pennsylvania, New Jersey, and beyond.
Fantastic. Thank you, gentlemen, for the introduction. Let's jump into the first question. Eli, I'm going to come over to you first. I want to hear about some of the challenges in developing affordable housing, for 21A, the project in Brooklyn that you have going on. So maybe you can kind of put that all together for us and share.
Yeah, if you want to talk about the challenges of affordable housing, I suggest everyone close their phones, get comfortable. We're going to be here for a while. In all seriousness, let's start at the highest level, right? Affordable housing doesn't make sense by a map, right? You're building a product that the incomes are below market, whereas the costs are the costs, right? That my concrete subcontractor doesn't sell me concrete cheaper because I'm building affordable housing or I'm building a hotel, right? Commodities are commodities, labor is labor, and yet I'm building a product whose rents are artificially suppressed below market levels. So right off the bat, you start off with math that doesn't work. So how do you fix that math? You fix that math by working with various government agencies from the federal, state, and city level to provide subsidies, tax credits, and all of that. And it's a tremendous effort of public-private partnership between the development community and government agencies to come up with the right policies, and then to effectuate those policies into financings to build affordable housing. But as I told everyone, over the course of my career, there have been times that this has been really, really challenging. There's been times where it's been a little bit easier. But developing in New York, no matter what you're building, it's not easy. It's an urban environment. It's infill development. So whether you're building affordable housing or multifamily, it's not an easy place to get something done in terms of construction of any degree of scale. That said, I think between the three of us here, we've been involved in thousands and thousands of units of the creation or preservation of affordable housing. So it gets done. Obviously, look at me, it's taken its toll. But, it does get done, and the math is not fun. You hit your head against the wall all the time. However, I will tell you that I'm leasing up a building in Inwood right now that has 611 apartments. The lottery, which means the open lottery for the lease up, will close next week. And for those 611 apartments, I will take in over 100,000 applications for people to live there. So as challenging as it is, the math, as challenging it is on the way in the beginning of my soliloquy, think about the math at the end of my soliloquy. How do I not get encouraged to do the next deal? Right, I have 100,000 people looking to live in 611 apartments. I was very blessed that I worked with Brendan on that when he was with the city. How do I not do the next deal? How am I not excited to do the next deal? Both from a pure business point of view of supply and demand, and then second, obviously, this is something that's needed, and this is something that is welcome. So I think that all the challenges exist whether you develop, anything in New York or in any urban environment. But when I am late at night and I want to hit my head against the wall, I think about how lucky am I to be in an industry where the supply and demand metrics are so favorable, and that gives me a lot of encouragement.
and that entrepreneurial spirit. So I really appreciate that, Eli.
Thank you.
Talib, I'm going to kind of say build on that, but what do you look for in a project and a sponsor? Coupling with what Eli just talked about.
So first of all, I appreciate the optimism at the end there. An old mentor of mine said he wanted his job to be intellectually challenging, morally rewarding, and financially beneficial to himself. And I think without all those three things working together, he would take a different job. And I think all of us in this room are very civic-minded, and I just appreciate that part of this industry tremendously. The money that we put out is not concessionary money, so we are trying to create cash flow for the operations of our organization. So on the one hand, we're looking for jobs that have a real actual return. We're also trying to find a affordable hook on it. And I think the way that we've been really effective in that, on the one hand, writing checks of $2.5 to $7.5 million is not really very available in the market. So we're talking to a lot of sponsors who are sort of aging out of their friends and family networks and other more sophisticated sponsors who otherwise couldn't march into Blackstone and say, can I have $5 million? It's not really a great product for them. So we think we're filling a very needed gap in the marketplace. And also, we're incredibly flexible. And one place that came up, we worked with these 25-year-old kids in North Carolina. They came to us a week before closing and said, we've completely screwed up how we communicated the water flow to our GP partners. And it looked like the deal was going to fall apart. We said, no way, man, this is what we're here for. We're here to help you out. We're here for you to learn. We renegotiated everything. We got there to the end. This was a deal that Ariel had brought to us. And we're thrilled to work with them. And so I think our flexibility, and honestly, as a developer for 20 years that Eli's alluding to, helps us know sort of where the addicts are. Among the sponsors that we look for, it's interesting, in that group of people, we're looking for a couple of things. We're looking for really strong character. Are these good people? We want to be known as a positive force in the marketplace. So we're really looking to, even on the way in, to vet the people that we're working with. I want sponsors that are thinking about how to move a job forward, even if they haven't been developers all their lives. I think often about who's the person that keeps a binder on their shelf of all the specs in the building that they're doing. So when the general contractor calls and says, hey, the tub's not available, we can't move this forward, that sponsor is going to take that binder down and call all the suppliers in the neighborhood until they can find that tub and bring it in. Even at a sort of early level developer, that is the most important aspect, is sort of creating something out of nothing and never letting anything stop you. And the last thing we look for in a sponsor, somewhere in this we have to be grown-ups. So we really think about how have you solved the upper tier obligations of being a sponsor? Have you found a guarantor? That is the most important thing. Have you figured out a way to provide guarantees to the bank? That's great. Do you have construction oversight experience? Some of the sort of technical aspects of that upper tier. So those are really the three things we look for in the sponsor, between character, the sort of ability to create something out of nothing, and the ability to bring in guarantors.
We echo that. Thank you. Thank you for that. All right, Brendan, over to you. Kind of a wide range of projects that you just described, from affordable housing to student housing. Just wanted, if you could talk about some of the challenges and what drives you in that space.
Yeah, I can talk a little bit about what we look for in new deals, and kind of restating some of what Eli said. We are affordable and mixed income housing developers, so I think the lens that we look at things through is significantly different than, I think, 100% market lens. A big part of it for us is identifying areas, cities, particular sites that the public sector has identified as critical to develop in order to advance some goal, whatever that goal may be. And oftentimes, it's a goal of creating transit-oriented development in order to galvanize a neighborhood and put more riders into a transit system. Sometimes it's filling a critical hole in a downtown that's otherwise thriving, but for the 200-unit sized gap that's in the middle of a main drag. So we really, I think, look to how are we working together through this project to solve some bigger problem. Clearly, in creating housing, and particularly affordable housing, we're solving a housing problem, but we're also solving other critical problems for society at the same time. And those can come in all different forms. Even if it's a few thousand square feet, and we have partnerships with a number of different organizations to use the community facilities in our ground floors, for instance. The work that those organizations are doing, although you might not see it at face value walking by a storefront, has impact on many thousands of people. So, I think we identify opportunities in that manner. I think we also, from a geographical point of view, we're doing a lot of work in New York City, a lot of work in other urban areas, including DC, but we are bullish on looking at kind of more gateway cities that are not your grand metropolises, but are cities that are kind of stepping into a different category in some cases, and where there's job growth, where there's economic development push going on various fronts, but there is a dearth of housing serving folks of all different incomes. So we're seeing those gateway cities as a real area of focus in the coming years. One example, and it I think could be classified as a gateway city in some sense, is New Haven, where we have a project that's a mixed income development, 25% LIHTC funded units, all serving households below 80% of AMI, probably a workforce component as well around that same size, and then 50% work for age with ground floor facilities, both retail and some community facilities. And that's one of those examples of it being a project that's obviously addressing a critical need for housing, both in affordable housing and increasing supply to address the housing crisis more generally, but also sort of filling in a gap at a critical piece of a downtown. And also, the fascinating thing about this site is that the city has taken the really courageous decision of vacating a portion of a major urban highway that runs through New Haven that kind of cleaves two different neighborhoods apart from one another. And the part of the land from the vacation of the highway will be dedicated to this fixed income housing development. So it's going to accomplish multiple purposes, and we see the benefit to the kind of complexity that comes with the transaction like that, and the ultimate impact of it.
Terrific. So let's kind of stay on that theme. Brendan, if I could, we're going to touch on policy and regulations a little bit and talk about 485X, the city of Yes, and what that provides us. And I'm going to ask each of you to kind of comment on that. And so, Brendan, if you could kind of kick us off on your thoughts.
Yeah, sure. It's a very simple topic, so I'll be brief.
I only have easy questions.
Brendan actually worked on this when he was with the city, so we're very
I did work on it, but it changed about 50 times. So I worked on version 3 maybe, but it's
That was the best version.
Thank you. You shouldn't. Clearly there was a need for a comprehensive zoning overhaul in New York City. It had not happened in that kind of comprehensive way since 1961. And we're at a time now in New York where I think it's pretty obvious to everyone, you don't need to be an insider, that we're in the midst of a housing crisis that's been enduring for decades. Just as one metric, looking at the vacancy rates across the city, it's just stunning that the level that they're at. If you look at affordable housing portfolios specifically, the vacancy rates are virtually zero. So we're in the midst of a housing crisis. I think there's been a general realization that the housing crisis, we can't fund our way out of it. We can't just fund affordable housing. We need to figure out a way in order to create more supply. And with more supply, the edge is going to be taken off, or there'll be a significant impact on the affordability of units more generally, as Shimon was pointing out in his presentation. So, City of Yes, was a really powerful vehicle for accomplishing those goals. I think it was based on the premise that density is our friend when applied in the right places. A bit of the controversy was around which are the right places, of course, but I think what ultimately resulted was a really great product and compromise that allowed for more housing to be built across the city, not just in certain areas, but across the city. And of course, allowed for flexibility on a number of different points, that have been introduced in some measure before, but not at this scale categorically. You know, one being parking requirements, obviously, and with the new tiered parking requirements, it frees up a lot of space and obviously reduces costs, so that developers can cater parking requirements to what they see as the realistic demand for those units and be able to market those units effectively. You know, clearly affordability being in the mix was a key component here with the universal affordability preference. You know, a more standardized way was established to create an affordability preference that was exchanged for more density, which is very powerful. As Shimon said, clearly the lifting of the FAR cap earlier in that same year was critical to allowing for particularly those higher density districts to get more FAR, and also more affordable units. So, you know, and then there's obviously a whole laundry list of other critical measures that were included in City of Yes, including enabling accessory dwelling units, ADUs, you know, kind of cleaning up the regulations around smaller micro units and shared housing, you know, providing incentives for transit-oriented development and many other things. So a very, very powerful program. And, you know, we've seen with projects that we've been looking at that were kind of midstream before and after, there's a real impact on the number of units that can be built and how they need to be built. And, you know, I think it remains to be seen exactly how this impacts the market more generally, and I'll leave that to Ariel to comment on, but clearly the power of these tools is very evident. And then as far as 485X, you know, it's a little harder to parse out, I think, the impact between the two of them as we look forward. Obviously, if 421A were exactly the same and we had a constant there, it would be a little bit easier. I think it's important that 485X came to be around the same time that effectively a new mandatory inclusionary component came into existence. It's more well aligned than the last regime. You know, there are requirements on it that can make it more challenging in certain environments, including the labor requirement. But, you know, it's, as I'll talk about this a little bit more later, but I think to have this consistent and predictable pairing of zoning incentives together with tax incentives to generate affordable housing is not something to be taken for granted, especially in, you know, one of the more complicated real estate environments on the globe. We go to other jurisdictions and there isn't necessarily the same consistency and predictability on those 2 points, and obviously being able to invest in a place is reliant on that kind of consistency and predictability. So I think that in and of itself will enable folks to be able to invest with confidence.
Thank you. So,
I'm not quite sure what to add here. I'm sitting between the guy who wrote it and the guy who's using it all the time. So I'll answer this mostly as a civilian, which is, it's interesting to look at the program overall and think about what it's saying to us, which is that there are a huge number of challenges to getting this done. The amount of subsidy going into affordable projects has gone exponentially through the roof in recent years. The amount of pushback on tax abatements has been high, although I think, you know, I applaud the people that got this through. Costs are higher, NIMBYism is up, the agencies are understaffed because of you know, the challenges that are there. So honestly, all of this is really just a supply-driven effort because I think there are not that many other options. There aren't many other levers to push. So reducing the parking requirements, increasing the density, all of these things are to say, well, what do we have here as a city? We have airspace, we have land, let's make the most out of that. Whereas there's so much pushback on creating some of these other tools, which historically have been very successful in creating affordable housing. And I think it's also a testament to the sort of sophistication of the affordable housing industry in New York City to come up with this. When you work in a lot of other municipalities, you don't see quite the same level of sophistication. So I find great comfort in knowing the sort of the thoughtfulness that the cities are addressing this kind of thing, especially with the kinds of limitations that they're working with.
So what you see is an important start, but doesn't get us all the way there.
You know, someone pointed out once that on any one of the things in City of Yes would have been completely shot down in committee if it had been brought out by itself. But to bring them all out at once and sort of flood the zone effort, right? But there's so much good in there, and I'm not even sure. I mean, honestly, where I sit in providing capital, it's after all the hard work has already been done to write the thing, after all the hard work has been done to make the project. All I have to do is pour money into the deal. So I have the kind of the easiest job on the stand here. But I actually think it's more than just a good start. I think it's really a tremendous accomplishment.
I'd like to add to the word accomplishment, I'll hit the nail on that. You have to remember, we've twice or three times in our careers have seen 421A lapse, right? Not, lapse, not existent, right? We got a piece of legislation and zoning text through, so get this straight. The last time the zoning text in New York was amended in any meaningful way was before the Civil Rights Act. It was during John F. Kennedy's presidential administration. I took my kids last year to Dallas to see a Mavericks game, and we went to go see where JFK was assassinated. And then when City of Yes came, I was very busy working on policy, and my kids, "What are you so busy with that?" And I sort of explained to them, I said, "You remember that gentleman who got shot where we went?" I said, "The last time that this legislation was touched was when that gentleman was president." And I think it really just goes to show you how out of whack sort of New York got in the terms of we can't get things done. We have tax abatements that lapse, right? I mean, we've gone through 2019, all the housing regulations. We've had a really tough run in terms of legislative environment, I would say, for the last 15 years. So I think City of Yes was more than just the details. It's like, wait a second, we can get things done here, right? It's a message to the investment and development community of New York, is there's still a bunch of us, people like Brendan, Tal, myself, a lot of you in the room, who are not willing to walk away and just say, well, we're bearish on New York, so we'll just deploy capital in South Carolina. Like, this was a last stand. I think City of Yes was a last stand to sort of answer the question that if I had to sum up affordable housing in one word and do a mic drop, which has always been like a band mic drop, and well, it's just supply, right? We can't write checks forever, and we have to come up with other ways to do this. So if it's density, if it's more creative zoning text, that's it. We cannot write checks indefinitely. We've gotten to the point where the all-in cost to develop a tax credit unit at 60% AMI in New York is, I would say, 4 to 5 times the cost of going out and buying that unit and an existing rent stabilized. Right? The costs no longer make sense. So if we don't add other elements into the mix, we were just writing checks into the oblivion, in my opinion. And I think, like I said, City of Yes was a statement to the real estate world that New York is not written off, and our legislators and our development community are going to take a stand and going to figure this out. So it was very optimistic to me. Now, nothing is perfect, right? Every program, version 3 was the best one, but even version 50 was great, right? It's not perfect, we'll figure it out. But we went through years of lapsed tax abatements, years of taking rezonings to the Court of Appeals in New York, right? I mean, what happened in the last 10 to 12 years was so incongruous to the thought of City of Yes getting done, that I think we all have to take a moment and be appreciative.
Thank you. So I'm going to jump to Section 610. If we can comment on that and the demand that it's creating and the long-term impact that you foresee on that.
Do you want me or you? Or you do a lot of this.
I'll step at this. I'll step in on this one. I guess I'll be the lessons learned person on the panel here. But it's interesting. We have a number of units that we own directly in New York City, and the ones that are economically working are Section 8 units. We don't have free market units. So I'm really talking about the building on the slide that had the belt around it. So I don't want to be speaking about New York City overall. But among the affordable housing properties that we're looking at for preservation, our Section 8 units are working. And when I look at 610, what it tells me is that the economics are not working of affordable housing once you get to the preservation stage of the development. And so 610 was really in some ways a Hail Mary back to the federal government and saying, we're struggling over here, the properties aren't functioning, they're economically unviable, we can't let capital improvements back in, we don't have the money to keep these properties updated. People are not interested in them. Now, again, I have very specific requirements around my investments. I know other people are looking at these assets as plausible and possible, sort of economically interesting ways to go. But for me, what I see is that a rent-stabilized asset without some support is struggling. And 610 is really the only place left that people have been able to go to get that to work. And I think that is sort of on a continuum with many of the Section 8 buildings that we look at, where those are working well. Stabilized properties without 610 are struggling, like not just a little, like they're not working. There's no cash flow. There's no ability to put money back in. They're just non-functioning. But then with 610, you have a little bit of a lifeline, and you're keeping your head above water just a little bit. So I think that it's a funny counterpoint on the.
Explain to everyone who doesn't maybe know what 610
Oh, that's super. It's actually a great idea.
Yeah.
So 610 is is basically an application that you can make back to the to HPD. Thank you, Eli.
Wow. Thank you, Tony.
You make an application back to the city and say, hey, my property is economically unviable. Will you allow me to take the full amount of my Section 8 rent on my Section 8 units? Now, there's a lot of details here, but there's sort of different levels of rent that are regulated in. But without 610, you're capped by how much Section 8 rent you can receive. If you get the 610 waiver from the city, you can receive the sort of full amount from the federal government of your Section 8 rent. So what that means is you're going back and you're saying, hey, the tenant here on this unit is paying me $300 a month. I was able to receive another $1,500, but if you can give me a 610 waiver, I'll be receiving $3,000 a month from the federal government. And you pool the number of units into one building that are getting that, and that actually creates enough cash flow that you can pay for your expenses. I mean, remember, we've got local law 97, local law 11. We've got insurance prices going through the roof. So I know there's a little bit of a Crimea River sort of issue around developers, but I'm looking at these buildings and I'm telling you they're just not working that well right now. And so the 610 waiver does sort of provide a lifeline.
A way to achieve some return.
Yeah, but I think it's important for people to note that a lot of times there's a little bit of irrational exuberance. Like when this came out, I think people thought it was going to be a faucet where the next day you were going to go from a 1.0 debt service coverage to a 150. It's a process. The approval process in itself, I have to commend HPD, it has become very, very efficient, but then implementing it at the property level is not overnight. And I think there was a moment in time of about 4 months when everybody thought, oh wow, my property's going to double in value within 60 days. And I think that exuberance has sort of waned off a bit. It's like any policy change. If you're a student of history, you'll know this expression. Our greatest dreams and our worst nightmares are seldom realized. I think when 610 came out, it seemed as if, it was the solve forward for multifamily in New York, and it's a great help, and it's a way for us to lean in and benefit more from federal subsidies to help New York. But that said, I still think, as Tal will tell you, there are real structural issues, with New York City multifamily that 610 will help. But, it's not the answer. It's not the whole thing. It's a lifeline, but there's a lot of swimming left to do.
Right. I don't think average to that, but
With that, we'll move to another topic, actually. So, Brendan, I'm going to ask you to comment about investing in New York City versus other locations, other areas around the country that you've been involved in, the different regulatory environment here in New York City, comparing markets. Wanted to get your insight on that.
Yeah, sure. So we, as I mentioned before, the majority of our work historically has been in New York City and the DC area, about 2/3 in New York City. So we're very comfortable with how affordable housing transactions are structured here, have strong relationships with the agencies, and know the interplay of all the various factors from tax abatements to financing sources to local laws that we need to be aware of in order to be able to put projects together. So there's always risk and reward to going to new jurisdictions. Going back to what I was saying before, I think it's I think less a question of the regulatory environment, but really how all the different housing incentives work together in order to be able to make a deal happen. And I think in New York City, it's such a tried and true system. As you said before, there's a really robust ecosystem of affordable housing development here, from attorneys to planners to architects to all variety of consultants in order to be able to execute on these transactions. And folks have been doing it together, solving problems together, staying out till ungodly hours in the morning to get deals closed for decades. So I think there's a real power to that to be tapped. And I think it's, particularly as you're looking to get creative, as we all need to be, there aren't, easy deals anymore, if there ever were. To be able to effectuate that creativity, you really do need that foundation of knowledge, experience, and trust. So, we're building that in the places where we're working now. We're from Massachusetts down to Maryland with some opportunistic work in Texas potentially and the Carolinas, and but really concentrated on the East Coast. And I think the I don't want to call it a challenge, but I think that the goal there is really just understanding those local markets and ecosystems in the way that we understand New York City. And a lot of it is about people. So we're very bullish, as I said, about places like New Haven that are gateway cities, places where they recognize that there's a problem to be solved, and that housing is one part of that solution. And I think we're particularly geared toward projects that involve partnership with the public sector. That's really what has driven a lot of the projects that we work on in New York City and DC. That whether it's public land or bringing in a tax abatement, or bringing in subsidy or tax bonds to generate long-term housing tax credit equity, or all of the above. Typically, we're trying to figure out how to make this kind of brutal math work that Eli referred to before, through the incorporation of incentives and replicating that model in other jurisdictions.
Thank you. Comments on that?
Yeah, I think there's a context here, which is that New York City had an affordability crisis for generations, and this apparatus that we're talking about has grown up around that. There was no affordability crisis nationwide, nor was there really that much money to be made for developers. And all of a sudden, there's a national affordability crisis. A two-bedroom rent in Cleveland is $2,800. It's gone
Last 10 years, even shorter.
Right.
Back in the day when we started, nobody wanted to do deals out of New York. The affordable deals out of New York are 30 units, 40 units.
There's no reason to go there. When that rent is up 250% in 5 years, suddenly people are saying, "Oh, what's happening in Cleveland?" And there's political will in Cleveland saying, "We need you. Please come here. Please come do this." So, we are one of the financing sources that has gone into other areas. We have 2 deals in North Carolina, 1 in South Carolina. We went down there with our list about how, what's the Section 8 process, how long does it take, how do, what's the sign off, what's the approval. We called, I'm paraphrasing, we called Diane in the office and we have a tenant the next day. It was just sort of completely unlike what happened in New York City. And that apparatus wasn't there, but it was really sort of to the benefit of the sponsor and even to the tenant who could move in quickly. Now I'm a tax and spend liberal, I like to see the regulation, but it does seem like there is an extension here that's gone quite far. I spent 3 years of my life trying to get a 421A tax abatement going back and forth with the city. In North Carolina, it's the regulating statute is about 7 lines long. There's a 1-page application with a few check boxes. Our attorney wrote a letter, we reviewed it, added a comma. 6 weeks later, we had a tax abatement. And that's money that we're using to go back into the property to deliver CapEx. The program attracted us as I think a very responsible owner, a wonderful sponsor who's taking care of the tenants in a wonderful way. And the program is working there in a way that is not just sort of functional at the end of the process, but the process itself is just a no-brainer. And so we're just seeing that in other areas, which is wildly different than what we see in New York City.
I think, at least for me, the biggest mistakes I've always made is when I've left New York City, mostly because I have to be honest with myself. I sort of ignored the first rule of the day, which was I would wake up, go downstairs, have a coffee and a bagel in whatever city I was, and I knew that that bagel didn't taste like it did in New York, and I should have stopped right there. But I've learned that I'm not great at sort of understanding supply. New York is where I've grown up. I don't even know how to drive a car and take the subway everywhere. I understand New York. I understand the flow of New York. That said, the reason that you're seeing capital dollars leave New York and go to these other places. So back in the day, 20 years ago, this June, I closed a deal as project manager with Tal as project manager for L&M. I was at the city, he was at L&M, called Parkview 2. Is that right? Parkview 2, yeah. It's sad when these projects are already out of the tax credit compliance. And to be very candid, I think you sold the tax credit on that deal, I think to WNC for over $1.10, maybe $1.15. Now, who would buy a tax credit that's worth $1 for $1.15, right? Nobody. But that was the market in New York because people wanted to invest in New York City affordable housing so much that they overpaid to get in. And I remember at the time asking, why do you do this? And they said, well, if we invest in Texas, the delta between the affordable rents and the market rents are very minimal. So we're taking on market risk at the affordable housing level. We don't want to do that. We'd rather come to New York and overpay and make less yield, but know that we have a safe investment. Well, what Tal said is those days have come and gone, right? Cleveland, one bedroom is not $600, it's $2,000 now. So you're seeing capital come out of New York and go to those places because the metrics have changed. Right now, I think the math in New York is going through a massive realignment. And it started, I think, in 2019. Obviously, COVID impacted every market. And it sort of continues now with higher interest rates and politics and political uncertainty, right? We have a mayor, may not be mayor in a few months. New York is definitely going through its adjustment period. To just give you some math at how sort of disconnected quantitative analysis and the regulatory environment is. I'm building a 473 unit, 75-25 luxury residential building on the corner of Tillery and Prince. I just had to get a reappraisal for the lender as part of a loan covenant. And we have the Affordable New York 421A Option E, which is one of the most robust options there because we had higher wage requirements on the construction site. So I don't know if any of you are familiar with how you evaluate a tax abatement. You run the tax abatement out, you take your savings, and then you net present value the savings back to know how much that abatement is worth. The abatement was worth more than the building. That's true. The abatement itself, if you build the building without the abatement, it's worth less than the net present value of the abatement. So we've entered into like the twilight zone, and we have to deal with it and roll with it. And like I said, I think City of Yes, 610, these are all steps of us realizing it and making changes.
Eli, that's a third mic drop, I think. I'm counting in this session here for you on that. Any additional thoughts around the luxury market here in Manhattan and in Brooklyn that you've been active in?
So I do luxury rentals, condos I used to do, but I sort of moved away from that from a tax efficiency point of view. I'll be very honest with you guys, at the luxury level in New York right now, everyone was wrong. Everyone who bet against New York in 2020, 21, 22 from COVID, they were wrong. I mean, condo prices on the Upper East Side are $3,000 a foot before you walk in the door and start, to get into more amenitized buildings. I'm talking about new construction. I own over 1,000 luxury residential rental buildings. My worst fears right now, which was in 2022, was sure, take anything you want, is when a friend of mine calls me and says, my son or daughter is moving to New York, can you give them an apartment at a good price? I can't. Can you give them a hotel room at one of your hotels at a good price? I can't. In 2022, I was giving away things just because it was nice to see somebody in the building. The compression and inflation at the luxury end of the market in New York is at an all-time high. I mean, I remember being in graduate school We're related, and Taconic built that building on the High Line, and they sold for $1,200 a foot condos. That was like 2002. It was like $1,200 a foot. I mean, like I said, any new development today, in all locations, is asking $2,500 a foot, and then you get to the good locations, and you're $3,000 a foot. Try to get a hotel room from end of Thanksgiving week to New Year's in New York. If you get a hotel room in New York that's less than $500, I tip my hat off to you. There's been tremendous inflation in that sector.
Without a doubt, I can vouch for that on that. So now I want to kind of move to more the advice piece of it, and Brendan, your experience at HPD and now on the development side. What advice can you offer the audience here today around that level of collaboration and dialogue that occurs?
Sure. The first bit of advice is that I should never offer advice. But I'll leave that alone. So, as I've said, in order to do the work that we do in the affordable housing realm, New York City requires really phenomenal creativity, and that public-private partnership is essential. So I think you need that foundation of trust. You need that communication between the public and private sector in order to be able to make complicated things happen. I've seen that when things go wrong in a deal, it's because you don't have one of those elements in place. One of those fundamentals is not in place. So, I think that New York is unique because I think folks appreciate the task at hand. On the public side, private side, nonprofits, everyone's aligned toward trying to address a common goal of addressing a housing crisis and an affordability crisis. So there are sort of higher goals that are always in sight, and that's really powerful because I think that means that when it's at its best, the public sector realizes that really to get to the creativity that you need in order to generate units, to do it for less money, to find ways to be able to lessen the time for putting units on market. You need to be creative. In order to have that creativity, you need that communication. I'd say that's sort of the fundamental. And from an advice point of view, I think one of the things that often gets forgotten in the affordable housing space, or not addressed, I think as acutely as it should be, is the question of why this matters in a particular project, right? And of course, you're going to need to know that the project works, that the brutal math eventually works out, that the returns are where they need to be in order to keep the lights on, that the tax abatement, trends the way that you need it to, and many, many other details, of course. But at the end of the day, I think if you can't convey why your project matters, what its impact is, and tell that story, then why would anyone else buy into that project and believe what you're trying to do? So I think that's the main thing, is really making sure that there's space and a consistent effort to explain why you're doing what you're doing.
Valuable, very valuable. Tel, over to you.
What the main thing I've learned today is never go on family vacation with Eli. You're going to get a lesson in land use history, which is worse than even land use. But I can't wait to go back. Sure. So it's funny. We have really focused our dollars on preservation deals, and you could sort of take this as you will, but maybe not-for-profits are sometimes a petri dish of new ideas. Maybe sometimes we're running into brick walls. Sometimes we're doing new things, but we're really thinking a lot about our obligations around creation of new housing these days. And I don't know what that means for the industry overall. Obviously, the two people on the panel here are building a lot of new housing as it is, but there has been a sort of retraction from that. There has been dollars leaving New York for many of the reasons we've discussed. But we are really thinking about how to get our money moving in New York and how to get dollars moving around affordable housing. Now, whether or not that is a sign of things to come, whether or not that's just a response to current challenges, We're bullish. We think it's important. We think that this is, as you say, that the rental rates have gone through the roof. Families are struggling, and there's a huge need to provide the supply to respond to the city of yes. And so I don't know if this is advice or not. I'm just sort of exposing sort of where our corporate thinking is on this and what we're going to try to be doing.
I'll take it as encouragement, so I appreciate that.
So, in terms of advice, at least as it relates to what I do for a living, affordable housing and any type of development, I'm sort of starting to realize maybe I'm past halftime in my career. That there's probably more behind me than in front of me. And the reality is, when I look back, I at least can share with you, I never thought, or I'm certainly not more intelligent than anyone in this room, but probably on the lower end. I think what I've really taken out of my career and I always put forward were relationships. I think what Brendan and Tel can tell you from being lenders, when Brendan was a lender, character means a lot more than an Excel spreadsheet. And all of these I've had operating agreements with developers who I can mention who are now not only out of business but incarcerated, and they meant nothing. They meant nothing because if you're dealing with a bad person, you can't paper around it. I think if you want to look at a long career in development or anything in real estate, it's an unregulated business, so you have to regulate yourself, right? We don't have the SEC, we don't have any other compliance, so you have to sort of regulate yourself. And I think the most important thing I can tell you is look at this stage. You have guys who've worked together for years, who've stayed in touch, been friends. Brendan wasn't joking. Twice he called me with news that I think he thought I was gonna have a heart attack on the phone. At one time, with the NEPA on, because I sat down on the street, like literally on the curb. He's like, and this is what's happening. And I sat down on the street. I have employees, I have payroll, my mind starts spinning. But we're all up here. There's probably 40 years of friendship up here and respect. And I think in the affordable housing business, when you really think of the ecosystem of what it takes to build one affordable housing unit, from the public sector to the private sector, to the lawyers, to the design folks, to the community boards, to the elected officials, I promise you, all of the actual professional acumen will always be secondary to character. And that's the best advice I can really give everyone.
That's extraordinary. So we heard about the why and communicating that, the encouragement, and then relationships that really are paramount to everything that we do here, especially throughout New York City. So extraordinary conversation, gentlemen. I thank you very much. I will end it with just rapid fire. Any last comment that you want to make? We'll start down, Brendan. Any last word to the group?
Keep being creative.
Creative. All right.
I said, there's always another deal, right? And you got to get through it. So even on a selfish level, those relationships are everything. So I really appreciate what Eli had to say.
Let's wish Brendan luck. He's an Eagles fan.
There you go. With that, thank you, everyone. Thank you, Shimon.